On the EA exam, non-recognition usually means one of three code sections. Section 121 is the home sale exclusion for individuals. Section 1031 is a like-kind exchange, but only for real property held for business or investment. Section 1033 is involuntary conversion, like casualty, theft, or condemnation, when you reinvest. Your job is to spot the fact pattern and grab the right section fast. With one question. Is it a personal main home? If yes, think Section 121. If it's a swap of real estate used for rental or business, think 1031. If the property was taken or destroyed, an insurance or a condemning authority paid out, think 1033. The exam loves mixing personal use words like primary residence with business use words like Schedule E rental. Here's the big trap. Section 1031 is not for your personal residence, it's for investment or business real property. So a vacation home or primary home doesn't qualify just because it's real estate. Meanwhile, Section 121 is individuals only and tied to your main home. If you see lived in it and primary residence, your brain should shout 121, not 1031. Section 1033 shows up when the taxpayer didn't choose to sell. Think fire, theft, hurricane, or condemnation for a highway project. The non-recognition idea is simple. If you replace the property with qualifying replacement property within the allowed time, you can defer gain. On Part 1, they often use personal use property examples. On Part 2, it's mostly business or rental property. Exam emphasis matters. For Part 1, expect main home sales under 121, involuntary conversions of personal use property, and 1031 exchanges of residential rental property you'd see on Schedule E. For Part 2, it's still 121, 1031, and 1033, but the facts skew hard toward business and rental assets, plus basis tracking. So always ask, personal, rental, or business? Marisol bought her home 3 years ago and fell behind on the mortgage. The bank foreclosed on January 10, 2023. The debt was used to buy the home, and it was her primary residence. She got a Form 1099-C for canceled mortgage debt. She wasn't insolvent and wasn't in bankruptcy. How should this be reported on her return? Think about which forms show the disposition and which handle canceled debt. The best answer is, report the foreclosure as a disposition on Form 8949 and Schedule D, and use Form 982 to exclude the canceled qualified principal residence debt. The tempting wrong move is treating the 1099-C amount as automatically taxable other income. But the exam wants you to separate two events, the property disposition and the debt cancellation reporting. Ethan is unmarried. He sold his home for $275,000 with $10,000 of selling expenses. He bought it 7 years ago for $125,000 and lived in it as his main home. He qualifies for the Section 121 exclusion. How much gain can he exclude from tax? Think about amount realized first, then gain, then apply the 121 limit. The answer is $140,000. Amount realized is $275,000 minus $10,000, or $265,000. Subtract his $125,000 basis, and the gain is $140,000. Because he qualifies for Section 121 and the gain is below the $250,000 maximum for an unmarried taxpayer, he excludes the full $140,000. The tempting wrong answer is $250,000, confusing the cap with the actual gain.